If you ask the average person what the biggest threat to the United States economy is, they usually point to the loud distractions on their newsfeed. They blame the AI bubble, trade tensions with China, or political figures battling for the Oval Office. The actual risk is something mostly ignored by traditional media. To find it, we have to look past the political theater in Washington, travel 6,000 miles across the globe, and land straight in Tokyo. The threat comes from the most boring asset on Earth: Japanese government bonds. Right now, American consumers are caught in a confusing economic paradox. Mortgage rates refuse to drop, stocks randomly freak out every few months, and even when the Federal Reserve talks about cutting rates, financial conditions still feel suffocatingly tight. Everyone is intensely analyzing Fed Chairman Jerome Powell's press conferences, but they are staring at the wrong end of the yield curve. Powell and the Federal Reserve have direct influence over short-term overnight rates. The long-term yields that dictate corporate credit and housing costs are driven by global supply and demand. And for the past 30 years, Japan has quietly acted as the duct tape holding that demand and our financial system together. In 1992, Japan's massive asset bubble burst. Real estate and equities collapsed simultaneously, throwing the country into what economists now call the lost decades, a 30-year period of stagnant growth, zero inflation, and frozen wages. To survive the freeze, the Bank of Japan pulled the only levers they had. They slashed interest rates to zero, and eventually below zero. Then they introduced yield curve control, a policy that forcibly capped long-term bond yields, essentially supergluing interest rates to the floor. This created an immediate crisis for Japanese institutional investors. Life insurers and pension funds sitting on billion-dollar portfolios were suddenly holding domestic government bonds that paid them exactly 0%. They needed yield to survive, so they went shopping overseas. This financial equation shows the exact mechanics they use to find that yield. An investor borrows money in Japanese yen at a near zero interest rate. They convert that yen into dollars, and they use those dollars to buy US Treasuries yielding around 4%. By keeping their own borrowing costs artificially low, Japan functioned as the world's ATM. They effectively became the cheapest, most reliable Wi-Fi network powering global market liquidity. In 2024, the Bank of Japan finally abandoned its yield curve control policy. After maintaining zero-rate policies for over a decade, they raised interest rates for the first time in 17 years, and then shortly after, raised them again. When Japanese yields rise, the math of the free money trade breaks. Borrowing in yen becomes more expensive, and the cost to hedge against currency fluctuations eats into the profit margins. That 4% US Treasury suddenly loses its appeal. These two dropping lines show exactly what happened when the math flipped. Immediately following the second rate hike, the S&P 500 dropped 6%, and Japan's Nikkei 225 plummeted over 12% in a single day, its worst collapse since 1987. As the carry trade became unprofitable, capital flows violently reversed. The money that had steadily flowed out of Japan to buy foreign assets was rapidly sold off and brought back home in a massive wave of repatriation. Global markets are currently colliding with an uncomfortable mathematical reality. The absolute cheapest source of oxygen keeping the entire global economy liquid for 3 decades is shutting off. For 30 years, Japan acted as the most consistent, price-insensitive buyer of US long-term debt, steadily absorbing the Treasury's bond issuance. The United States relies heavily on this arrangement. The government runs massive annual deficits, meaning the Treasury must issue huge amounts of new debt every year just to keep the lights on and the economy functioning. This seesaw illustrates the immediate problem. If the Treasury's largest foreign buyer removes their demand from one side, the US must raise its yields on the other side to attract replacement buyers to absorb all that new debt. As billionaire investor Ray Dalio points out, the bond market serves as the ultimate baseline for valuing all asset returns. It dictates the true underlying price of capital across the board. When long-term yields remain elevated, financial models compress the present value of future cash flows. Stock valuations fall. Corporate borrowing costs stay high, causing businesses to tighten capital, reduce risk appetite, and freeze their growth plans. This traps the everyday consumer as well. Because mortgage rates are anchored directly to long-term Treasury yields, a lack of foreign demand keeps those rates elevated. Housing affordability stays strained. refinancing disappears, and home transactions stall out, regardless of whether Jerome Powell cut short-term rates. The narrative that a single Federal Reserve rate cut will magically fix our financial conditions ignores the math. If global liquidity tightens because Japan steps back, the cost of money rises everywhere. Let me know in the comments. And if you enjoy calm, practical conversations about money, consider subscribing. I'll see you in the next video.